So from a process standpoint, when we look at the individual, how we buy and sell individual companies and how we build a portfolio, it's done the same way in the fund as we do in individual stocks. The analysis is the same. The risk and reward requirements are the same. So, but in everything we do, whether it's in the individual portfolios or in the fund itself, creating a margin of safety is a significant part of our thinking. And so, but that starts in the screening process. So when we're screening for stocks, and I'm going to use a small cap example for this, when we're screening for small names or small cap companies, there's 4 primary criteria we look at. We want low financial leverage, meaning we want good balance sheets. We want high operating leverage. We want a wide range historical valuation range, which means we want big value gaps. And then we're looking at structural changes within industries. We want structurally sound industries. So let's take each of these in turn. The low financial leverage, what we mean by that is we want 25% debt to capital or less, so very strong balance sheets. We're not interested in having bankers become business partners. They have a different agenda and sometimes muddy the water, so that's not of interest to us, so we want very strong balance sheets. Second, we're looking at high operating leverage. What that means is we want companies that are under-earning their earnings potential. And a lot of times this means it's a cyclical company. It's like an Apogee Enterprises that makes zero, maybe 10 cents at the bottom of the market, and at the top will make $2.50. So there's a wide range in their earnings. So the earnings growth is wide in these companies. That also, it doesn't have to be a cyclical company. It could be another business where they've added another end market or they've added a new product line where that incremental revenue contributes disproportionately to the margins. And then we want, as I said, wide ranges in the valuation range. Basically, we want a big difference between the buy point and the sell point. You make more money that way. The wider the gap, the more money you make. And then finally, structurally sound industries. What we mean by that is value investors are usually many times looking at companies that are out of favor. Their industries are in down cycles and they're out of favor. So it's really important to differentiate between a cyclical downturn and a structural shift in the industry. A while back, we were looking at the energy industry. We were always looking at the energy industry, but in studying the oil and gas industry, I'm sure many of you are familiar with that in Houston, the fracking technology has opened up vast reserves and created tremendous production of natural gas, which has brought down the cost of natural gas, which has meant those that are drilling purely for dry gas are suffering. Their drilling costs or their cost of production is much higher than the gas price today. That's a structural shift that we've seen in the gas industry. So that means we want to avoid those companies that are going to suffer because of it. But it also opens up opportunities for those that will benefit because of it. For example, the chemical companies are benefiting because of the low natural gas, which means we're seeing, as Arnold pointed out, a tremendous amount of money being invested in new capital spending programs for gas business, for chemical companies. So that's an opportunity for us to look at companies that will be supplying the chemical build-out. So the Jacobs Engineering, for example, a big construction company, they're big in building chemical plants. But we can go down the line from Jacobs and look at other companies, some here in Houston, like Powell Industries, that supply capital equipment to that industry. So looking at structural changes within industries helps us avoid some, but get into others where they're going to benefit, where the wind will be at their back. So once we've done all this, once we've gone through this screen, we do our HMA analysis like I showed you with Apogee, and then take all of those and put with our worst case buy point and sell point and put it into our dashboard. And from that, we sort based on reward to risk ratio. So now let's take a look at our criteria that we screen on and buy stocks on, how that gets represented in the portfolio. So currently, the fund has 60 securities, and the average market cap is $720 million. That compares to 1,400 securities in the Russell 2000. In the 2000, there's 1,400 that are in the value, categorized as value, and their market cap is about $1 billion. The average market cap. And then if you look at the S&P 500, there's 500 companies, $115 billion. So where we're finding value tends to have a smaller tilt even relative to the small cap index itself. Now let's look at whether our screening, their screening process, how that's reflected in the portfolio. As I said earlier, we want really good balance sheets. So we're screening for 25% debt to capital or less. What we actually have is 12.5% debt to capital. So we have exceptionally strong balance sheets. In fact, if you were to add cash to that number, we'd virtually have no debt on a consolidated basis on the portfolio. That compares to 39% in the Russell and a roughly 37.5% in the S&P 500. We wanted a high operating leverage, which means we want growth in our earnings going forward. Here you can see the 3 to 5 year projection. These aren't our projections, by the way. This is consensus estimates by FactSet. So our growth is 10.39, slightly higher than the Russell 2000 itself, and slightly less than the S&P 500. So again, we show good growth in earnings going forward. Now let's look at from a valuation standpoint. We want to buy them cheap. So this is a metric that we use called enterprise value to sales. Arnold spoke about this earlier when he said you can either invest in a new business or you can buy another one. And if you can buy another one at 45 cents on the dollar, it's cheap. Well, here we are. Our portfolio is 49 cents on the dollar. That means you can buy the company, including the debt, paying off the debt, and it's 49 cents on the dollar. Relative to the Russell 2000, where you have to pay just about a dollar for dollar, 95 cents on the dollar, and the S&P, you have to pay 1.6 times a dollar. So from a valuation standpoint, we're cheaper than both indexes. Now let's look at price to book. 1.1 for the fund, 1.19 for the Russell 2000, and 2.18 for the S&P. Now, to be fair to the S&P, it's always going to sell at a premium to the small cap funds, but nonetheless, you can see the fund has a much better balance sheet than both the indexes. It's got very good growth prospects, and on valuation, it's cheaper than both funds. So we've seen that the small cap stocks on their own are relatively cheaper than the indexes. Now let's look at it from an absolute standpoint. We've already talked about how we take the reward to risk of each stock and put it into our dashboard. Well, what this chart represents is the reward to risk for the fund itself in total. So we take all of the reward to risk ratios of the holdings of the stock and create a reward to risk ratio for the entire fund itself. We started the fund in April 18th of 2011, which is all the way on the left side of the chart. At that time, the reward to risk ratio is 1.81 to 1. Not cheap at all, which is why we funded it with internal money. Then you can see during the third quarter of 2011, when the U.S. was supposedly going to default on its debt, when you had the problems arising in Greece and Europe, you had the fears of a double-dip recession, and all of that fear caused people to sell stocks. And what happened to the fund? The reward to risk ratio went from roughly 2 to 3 up to 5, then up to 8, and then for 15 minutes on October 3rd, 2011, it went to 8 to 1. But that was 15 minutes of the day. The day before it was 10 to 1, the day after it was 8.5 to 1, and it's never been that high since. But look at what period of time that was. It was a very short period of time. So when everybody else was selling, it was creating tremendous opportunities for us to buy. We bought individual stocks. We saw the cash in the all-cap portfolio go from 30% down to 12%. That was us buying companies during that time frame. Let's take a look at it from another perspective. This is the same information, but I put it into a tabular form. So if you look at the 5 to 6, what that means is any time that the fund offered a 5 to 6 to 1 or better, 5 to 6 reward to risk ratio, that's the yellow bar. The frequency means in the second column where it says 21, that means there's been 21 times where the fund had sold between 5 to 6 to 1. And if you look at the cumulative where it says 56, there's only 56 days in the 350 days that the fund has been open that it has been higher than 5 to 1 reward to risk ratio. That's equal to just 16% of the time. And if you look at 8 to 1, it's only been there 14 days, 2 weeks at 8 to 1 or higher, which is 4% of the time. So in those downturns, it feels long. That 56 days, that's about 2 months. It feels long, but it's not really. It's not really that long, and that's the time that we have to buy. That's when the most opportunity is available. Now, where the fund mostly is in the 3 to 1 or less. That's 68% of the time. What this means is we don't have a lot of opportunities, but when they are, we must take them. So just like in small individual companies, at 5 to 1, we think it's the buy point. At 8 to 1, it's a gift. But it's all about buying the value gap when it's apparent. So while I can't predict when the fund or any individual stock or index, or for that matter, any of them can get to a reward to risk ratio that we've just seen, what I do know is that human nature repeats itself, and it will continue to create value gaps. And when it does, we certainly have the methodology, the process, and the mindset to be able to capitalize on them whenever they happen and wherever they happen. For individual accounts, we're going to continue to execute our all-cap strategy just as we always have, with the principles that both Arnold and I outlined. So with that, I'd like you to leave you with one last thought. And that is, the next time that volatility spikes and you get a bit nervous, because I know everybody does, then think about Ben Graham's quote and remember the value gap. And how do you capture that value gap? Because not only will that calm your nerves, it's going to make you money. Thank you very much.